I'm wondering if you could bring us inside the conversations a little bit that you're having with investors and why such a muted reaction as you're trying to pivot your business. Is there something you are communicating with them on how quickly you can pivot and when it'll start to pay off for them?
So just for the avoidance of doubt, I am not trying to pivot our business at all. And my long-term investors have been extremely supportive and appreciative of what we've done. The market seems to be having a bit of an identity crisis, as you just covered, and we are certainly not. We are a growth technology company. We delivered and continue to deliver and forecast exceptional growth and pretty great technology, if I do say so myself. Just look at the last quarter's numbers that we reported. We 20x'd the merchant coverage. We grew GMV and the consumers 100% better than 100% each. The thing that the conversation I think you're alluding to is this question of, well, so yeah, sure, you're growing, but where's the revenue? And we grew revenue by 77%. We grew revenue less transaction cost by 93%. That should give you a pretty good sense that as we scale these giant partners, we also improve the unit economics. And over a long time, I think a business that grows at 100% plus or minus rates and improves its unit economics generates enormous amounts of cash flow. And so scaling the network is what we're doing, and we are not pivoting away from that whatsoever.
Well, one question I have beyond that too is if you're working with partners and a partner like Shopify shows slowing growth, how much are you tied to their fortunes? And how much are you tied to the fortunes of Amazon to the extent that, when is this partnership going to pay off in a way that investors start to reward it in a bigger way?
Again, I think the market will decide what the market will decide. We are growing extraordinarily well within Shopify, far faster, I think, than Shopify just reported, which makes sense. We're gaining excellent traction within all the many Shopify merchants. We also work for a long time very successful with Walmart.com. We work, of course, now with Amazon, with Target, with many very large enterprise partners of ours, and literally hundreds of thousands of small merchants. The coverage there and the expansion within that set is not limited by the growth of e-commerce itself. It's actually how much share we're taking away from other payment instruments, credit cards in particular, and how much we are helping consumers buy things responsibly and with a sense of control and certainty, which creates transactions that wouldn't have existed at all. So the Affirm effect, as it's known among merchants, is this 20, 30, 40% bump in sales that just wasn't there prior by consumers who decided to transact because Affirm feels safe and credit card feels scary, especially in a world of rising rates. So I feel very, very good about our growth prospects with our major and small partners, but also within their overall volume. And I think in terms of the payoff to investors, again, if you just sort of look at the revenue less transaction cost and look at the trends of the volume that we're producing, multiply that out a couple of years, you'll see a pretty staggering amount of free cash flow, and that's where we're headed to. We'll continue investing, so I'm not going to promise, on this date you will start seeing positive numbers, but that's certainly a huge goal for any company. Eventually, you want to be fully self-sufficient and generate free cash flow.
So the buy now, pay later thing is relatively new. You've been, of course, Shonali says you were in the PayPal mafia. I love the way she describes that. That's the language we use. But basically, you've been an innovator in the pay space for decades now. What does Affirm have with buy now, pay later that's able to hold off competitors? Why can't any bank come into this space and do it? And isn't it more expensive in a time of rising rates?
It's far more expensive for consumers in a time of rising rates to use credit cards. My argument, by the way, has been from inception that it's just always very expensive for consumers to use credit cards, in particular because no one can do exponential math in their head, and Affirm is one of the very few, if not the only players, to neither charge late fees, nor engage in gimmicky transactions, and not compound interest into principal. And so the product really makes consumer feel and be in control. And that is not something most banks or most startups are willing to do. It's actively building a product that is consumer first, and it's hard to do. It's hard to do without exceptional technology and even better risk controls and underwriting. And that's a unique secret sauce that has propelled us to this place of growth and will continue powering us beyond. And in the rates rising environment, ability to underwrite and select good risk versus bad risk is a key advantage. So in general, as the financial situation becomes less rosy, sort of the last 10 years of expansion, we tend to benefit from it. Consumers need us more, and our ability to differentiate against our competition just goes up exponentially as well.
Max, I just want to circle back on that point, because you started the conversation by talking about the general market reaction to companies that are growing, and we're having this daily conversation around higher interest rates. You're saying that this changing rate environment is potentially beneficial to your business at a time when we've seen the market selling off a lot of these growth stocks because of higher interest rates.
Absolutely. So a double-digit percentage of Affirm's volume is 0%, which that is to say consumer does not pay any interest. Before and after Fed changes the rates, your credit card may have been offering you 9% APR, which seems really low and reasonable and good. Whenever that moves, your credit card will move along with it, and the price of credit from your piece of plastic will go up, while Affirm's 0% transaction will still be zero with no late fees, even if you're late, even if you have to reschedule. And so our differentiation vis-a-vis the traditional payment providers just improves. Moreover, consumers become less and less easy with what's going to happen in their personal cash flow as rates go up and as sort of various news cycles tell you all about scary things that have to do with hyperinflation, et cetera. Affirm is in the business of providing clarity and transparency to the end consumer. We have seen incredible demand in the beginning of the pandemic as consumers were feeling confused and trying to figure out how to make ends meet. We absolutely expect, as the economic climate worsens or becomes less certain, to see more demand.
You know, I'm really curious about this too, because on one hand, you have credit card companies really throwing rewards at clients, and tons of buy now, pay later companies hopping up and doing things that you don't necessarily do, like allow customers to use their credit card to buy now, pay later. That's like double leverage if you think about it. Max, you know, are you worried at all about loosening credit underwriting out there and what that could mean for your rivals and the banks?
So I worry for my competitors, and I certainly worry for anyone who lends money in a form of line of credit, because as you commit to a line, you end up holding the bag, whatever happens to the consumer, because the limit has been extended once and for all. Affirm underwrites every transaction. We thrive in the environment where consumer gets a sense of clarity. They know exactly that they're in control. And most importantly, we are actually very, very good at underwriting. We've been doing this for quite some time and have lots and lots of exceptional data that shows that we do well. Most importantly, actually, if there's one thing that I would like the market to sort of understand about Affirm, delinquencies and defaults are an input into our business decision-making. Vast majority of players look at their book and say, oh no, what will happen to me? Look at the macroeconomic environment, things are worsening. That is not how we run the company. We decide what acceptable delinquencies and defaults will be for us to make sure we continue growing at the kind of pace we want. And if we feel the macroeconomic economic environment will worsen, we in fact tighten and address it, and we change our settings literally every single day. So all of that makes me feel very, very comfortable about the performance of our book, not as much about the competition.